Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. A tech stock surge electrifies Wall Street on trade hopes, but a hidden danger signal flashes as the rally's foundation crumbles. Is this a bull trap? Second, Fed's high-stakes gamble, rate cut decision flying blind as an internal war erupts. The market is pricing in a 100% chance of a cut, but what is the hidden stealth easing plan that could inject massive liquidity back into the system? Finally, Nvidia's China bloodbath, a $10.5 billion loss, triggers a shocking pivot to topple a telecom giant. After being forced out of China, Nvidia makes a stunning $1 billion bet to challenge Huawei's dominance. Is this a desperate gamble or a masterstroke to control the future of wireless? Breaking news electrifies Wall Street. US-China trade negotiations show a breakthrough, sending tech stocks soaring and setting the stage for a market rally. The Nasdaq surged 0.8% to a new high of 23,827.49. With tech giants leading the charge, why does this matter so much? The ongoing trade tensions between the US and China have been a significant source of market volatility, leaving investors on edge about supply chain disruptions and tariff impacts. The latest progress in negotiations offers a glimmer of hope, suggesting a potential easing of these tensions, which could stabilise global trade dynamics. This optimism was further bolstered by the expectation of a Federal Reserve rate cut, adding a double boost to the market's momentum. Investors are now recalibrating their portfolios, betting on tech and semiconductor stocks that are heavily reliant on Chinese markets and supply chains. However, there's a cautionary note. While the headlines are positive, no formal deal has been signed yet. The rally is primarily concentrated in tech, leaving small and mid-cap stocks lagging, which could be a warning signal if the negotiations falter. Technology was the clear leader today, with Apple climbing 2%, Microsoft hitting new highs, and Nvidia rallying strongly. The Semiconductor Index, SOX, outperformed the broader market, rising 1.5%, indicating robust investor confidence in this sector's growth potential. Here's what to watch closely. First, keep an eye on the upcoming earnings reports from tech titans Meta and Apple next Wednesday and Thursday. Any misses in expectations could test the Nasdaq support at 23,000. Second, monitor the 10-year Treasury yield, currently at 4.3%. If it breaks above 4.5%, it could pressure growth stocks, signaling a shift in market sentiment. As for sector positioning, if you're holding tech-heavy portfolios, be vigilant for any signs of defensive sectors like utilities, XLU or consumer staples, XLP, gaining traction, as this could indicate a market pivot towards safety. Now, let's take a closer look at the specific stories driving today's action. The Federal Reserve is about to make a major decision on interest rates, but they're making the call while flying, almost completely blind. A government shutdown means crucial economic data, like the September non-farm payrolls report, is completely missing in action. A while back, we talked about the brewing race to reshape the Fed and how a more market-driven, less model-anchored approach could make forward guidance, the famous dot plot, less reliable and volatility higher. That lens matters here. With key data dark, the committee is already being forced into exactly that real-time reactive mode. The non-farm payrolls report, produced by the Bureau of Labor Statistics, is considered the gold standard for understanding the health of the US job market. It's based on a massive survey of about 122,000 businesses. Without it, the Fed is forced to rely on less reliable, more volatile weekly data, like state-level jobless claims. The key here is the risk of a policy error. If these proxy indicators paint an inaccurate picture, the Fed could cut rates too aggressively or not enough, simply because they don't have the best information. Despite this data blackout, markets are pricing in a nearly 100% certainty that the Fed will announce another quarter-point rate cut. But now, get this, a battle is raging inside the central bank. A former Fed director calls it a genuine disagreement among policymakers. We previously flagged that some current voices at the board have been pushing for more aggressive easing. Today's setup makes those dovish arguments louder. This disagreement is happening within the Federal Open Market Committee, or FOMC, the 12-member group that actually votes on interest rates. While they usually aim for consensus, dissents are a powerful signal. A dissent in favour of more aggressive cuts, what we call a dovish dissent, can suggest that the official communication from the Fed isn't telling the whole story. It hints that the pressure to cut rates faster and deeper is building internally. As we discussed before, dissents can reveal stress beneath the Fed's official script, especially with longer-term leadership questions still in the background. The situation presents a fascinating duality. On one side, you have the hawks who are reluctant to cut further, while on the other, the doves who believe it's time to do more now. The division is clear. Newly appointed Governor Stephen Mirren previously dissented in favour of a bigger half-point reduction. At the same time, multiple regional Fed presidents have expressed hesitation to go much further. Caught in the middle is Chair Jerome Powell, who has to navigate this growing divergence of opinion while signalling the future path for the economy. This tug of war echoes the broader stakes we covered earlier. Shifts in the board's makeup can steer policy for years, even before any new chair is named. But that's not the whole picture. The Fed is also deciding when to stop reducing its massive $6.6 trillion balance sheet. This process, known as quantitative tightening, could be in its final stages, and its end could inject significant liquidity back into the markets. Remember our note on reformers who want to overhaul the Fed's operating framework? Decisions around QT sit right at the intersection of that debate. And here's the thing. Ending quantitative tightening, or QT, is a form of stealth easing. During QT, the Fed removes money from the financial system. Ending it means that process stops, effectively leaving more cash in the system. This extra liquidity can act as a tailwind for assets like stocks, independent of any interest rate cuts. One key indicator to watch is the Fed's overnight reverse repo facility, or ONRRP. Its usage has been dropping fast, signaling that excess cash is being absorbed and that the end of QT is likely approaching. This all leads to a dramatic set of predictions. One chief economist forecasts a rapid-fire series of rate cuts, not just this week and in December, but continuing into January, March, and April of next year, all driven by underlying worries about the labour market. But as we said before, the market is great at pricing the next move and terrible at pricing the next regime. Unresolved leadership questions keep the medium-term strategy a question mark. This all points to a major shift in the Fed's priorities. The central bank has a dual mandate: stable prices and maximum employment. For the past few years, the focus has been entirely on fighting inflation. But these predictions suggest the Fed is now pivoting to prioritise the weakening labour market, even while inflation remains stuck above its 2% target. This is a big deal because it challenges the Fed's inflation-fighting credibility. It's also why we warned that any hit to perceived independence can de-anchor expectations and raise longer-term risk premiums. For our audience in the Chinese-speaking world, this has direct implications. An aggressive Fed easing cycle, while other central banks like the People's Bank of China remain more stable, tends to weaken the US dollar. This makes the Chinese yuan relatively stronger, which can affect the competitiveness of China's exports. However, it also gives China's central bank more policy flexibility to manage its own domestic economy. A few episodes ago, we also flagged a tail risk. A more politically aligned Fed chair could face pressure to use policy in a currency confrontation with China. That's not today's baseline, but it's a wildcard worth keeping on the radar. So, what's next? In the short term, a more aggressive Fed could lead to a weaker dollar and lower bond yields, which could be supportive for assets like stocks and gold. The key things to watch will be the Fed's official statement for any change in language about the labour market, the pace of decline in that ONRRP facility we talked about, and as we highlighted before, the 10-year break-even inflation rate as a credibility check. The stage is set for a high-stakes policy meeting. The Federal Reserve is navigating a data vacuum, deep internal divisions, and the end of a multi-trillion-dollar policy, all while Wall Street expects clear and decisive action. From the Fed's high-stakes gamble on the economy, let's shift to the tech world where Nvidia is making some equally audacious moves. So, Nvidia's fastest AI chips are now in full production in Arizona. This isn't just a supply chain update. It's a major strategic shift away from the company's long-standing manufacturing base in Taiwan. The move reportedly came after a direct request from Donald Trump to bring production back to US shores, with CEO Jensen Huang citing national security and American jobs as the key drivers. A while back, we talked about how US de-risking would eventually show up, not just in policy, but in where the highest value chips are actually made. This is that moment. Actually, this move is part of a much larger government-backed plan. It's a direct result of the US CHIPS and Science Act, which allocates a massive $39 billion in subsidies to bring semiconductor manufacturing back to American soil. In fact, Nvidia's key manufacturing partner, TSMC, has already been awarded $6.6 billion to build its advanced factories right there in Phoenix, Arizona. The key here is understanding the trade-off while producing chips in the US. Might be slightly more expensive, creating what some analysts call a geopolitical premium on hardware. The goal is to create a more resilient and secure supply chain, insulating America's most critical technology from global disruptions. We previously analysed that geopolitical premium as higher near-term costs in exchange for durability. Today's announcement is the clearest operational proof of that trade. Demand for these chips is exploding. Nvidia has already shipped 6 million of its new Blackwell GPUs in the last 4 quarters and is forecasting a staggering $500 billion in sales from its next 2 chip generations combined. We've also noted before that markets are hypersensitive to ramps like this because so much of the index now hinges on a few mega caps AI guidance. What really brought this to a head is the sheer scale of this investment. We're talking about a wave of spending so enormous it may be powerful enough to support the entire US economy. You see, major tech companies are in a full-blown AI arms race. According to S&P Global, Microsoft plans to spend $80 billion on capital expenditures in 2025, an 80% increase. Google is looking at $75 billion, and Meta is forecasting up to $65 billion. A huge portion of that money flows directly to Nvidia for its GPUs. This concentrated investment in what's called information processing equipment is now a significant driver of US GDP growth, potentially strong enough to offset weakness in other sectors, even with high interest rates. But remember what we discussed a while back. Valuations are already rich and concentrated, and the payoff still has to clear the productivity paradox. The question isn't whether the money is being spent, it's whether measurable efficiency gains show up quickly enough to justify it. When we place Nvidia's US expansion alongside its struggles in Asia, the contradiction becomes clear. US export restrictions have already cost the company over $10.5 billion in lost sales to China. In a stark admission, the CEO recently stated that Nvidia is currently 100% out of China with no market share there. We flagged earlier that Asia has been the engine of a lot of AI manufacturing and that de-risking would be stress tested. This is that test in hard dollars. Believe it or not, that $10.5 billion figure isn't just a number in a financial report. It's the first tangible hard cost we can assign to the US-China tech decoupling. For China, this accelerates the push for domestic substitution in high-end chips, a difficult but necessary path that will reshape its entire tech industry and job market. For the US, it creates a difficult balancing act. The government has to weigh its national security goals against the risk of damaging the profitability and R&D capacity of its own tech champions like Nvidia. And as we've cautioned a while back, serious competition from alternate chip makers to in-house silicon could pressure Nvidia's historically high margins, making this balancing act even trickier. This is where the situation takes a more complex turn. In a stunning pivot, Nvidia is now partnering with Finland-based Nokia, taking a $1 billion stake to build 5G and 6G base station technology. The goal is to create a powerful American-based telecommunications alternative. It also subtly diversifies Nvidia beyond data center GPUs at a moment when we've been watching for margin pressure from new rivals and custom chips. Here's where it gets interesting. The specific technology that makes this partnership a real threat to the old guard is called OpenRAN, or Open Radio Access Network. To put it simply, think of traditional networks from a single company as a pre-built computer where all the parts are sealed together. OpenRAN is like building your own PC where you can pick the best processor from one company, the best memory from another, and have them all work together. This breaks the vendor lock-in of traditional players and allows for more competition and innovation. The strategy was laid bare with an incendiary quote from Huang, who declared, "Our fundamental communication fabric is built on foreign technologies. That has to stop." This is a direct challenge to the global dominance of competitors like Huawei and a high-stakes play for the future of wireless networks. This signals a new era where corporate strategy and national strategy are becoming one and the same. CEOs are now major players on the geopolitical stage. So, what should we watch for next? 2 key things. First, keep an eye on announcements from major telecom carriers. Will they begin adopting this new OpenRAN technology in their networks? That will be the true test of this strategy's success. Second, continue to monitor the capital expenditure guidance from big tech. As long as they keep pouring tens of billions into AI infrastructure, it will act as a powerful tailwind for the US. Stock market and economy. As we said a while back, even a modest cooling in big tech capital expenditure can jolt markets because of how concentrated leadership has become. And on the return side, the clock is ticking. If the promised productivity payoff doesn't materialize over the next few cycles, those elevated multiples get harder to defend, especially if margins start to compress. From moving its most critical manufacturing to the American Southwest to making $1 billion bet on next-generation wireless, Nvidia is no longer just a chip maker. It is a geopolitical heavyweight, redrawing the map of global tech dominance right before our eyes.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.